So yeah, the star of the week this week is Happy Belly Food Group, or HBFG, on the Canadian Securities Exchange. Now, the company is our star of the week as it is up 417% year to date, where it's currently trading at about $1.24 per share, and has a market cap of about $159 million. So, Happy Belly's mission is to be a leading consolidator and accelerator of emerging food brands. The company's portfolio consists of two operating divisions. Number one is its quick service restaurants, or QSR, and number two is its consumer product goods, or CPG. So, looking at its QSR right now, it operates about 8 brands, which include Heel Lifestyle, Lettuce Love Cafe, Puro Fresh, Greek Grill, Joey Turk's Island Grill, Rosie's Burgers, Via Kibo Italian Street Food, and Yolk's Breakfast and IQ Foods recently. And they've got two CPG brands, which include Holy Crap Foods. I'm pretty sure that they make breakfast cereals, and then as well as Lumber Heads Food, which is snacking foods, kind of like popcorn and whatnot. But if we look at the last quarter, about 83% of revenue was coming from the quick service restaurants segment. And I should also note that this table here doesn't include their most recent acquisition of 50% of Salus Foods, which has 9 store locations in Ontario. So let's take a look at what's driving the increase. Well, number one, as I mentioned, the company has been making acquisitions, which they've done 4 this year. And the first was for 100% of Crave It Group's Via Kibo restaurant chain, which has 7 locations, but also 4 Reef Kitchen locations, which are actually like essentially ghost kitchens. And they did pay in stock for the acquisition at a price of about 6 times EBITDA. The second acquisition here, 50% of Yolk's Breakfast Inc., which has 3 locations, I believe in BC. And they acquired it by issuing shares. 100% of IQ Foods, which has 4 locations. But I couldn't see in the press release exactly how they paid for the acquisition. And the last here, most recently, 50% of Salus Fresh Goods, which has 9 locations in Ontario, and they issued shares at a purchase price of about 4 times EBITDA for Salus. And they also have the option to buy the other 50%. So if we look at the financials, we can see that they have certainly been trending in the right direction as well, which has been driving the share price higher. Revenue was up about 26% compared to Q3 of 2023. Net income was a loss of $160,000 compared to a loss of $149,000 in Q3 of 2023. And adjusted EBITDA was positive at about $198,000, which is the third consecutive quarter of positive adjusted EBITDA. Now, the balance sheet is also quite reasonable. It does have a slight net debt position, but we would certainly like to see improved profitability and cash flow to show that they can indeed pay down debt. But I do assume that if the company stays on its same path forward, its debt is reasonable. And using the Q3 annualized adjusted EBITDA, I'm getting a forward net debt to EBITDA multiple of about 2.6 times. So it does look higher right now, but as long as profitability and adjusted EBITDA continues to trend in the right direction, I do believe that this will come down. But of course, it also depends on how they fund future acquisitions and if they take on more debt. So, looking right now at the valuation, I would certainly say that it is pricey. As if we annualized EBITDA in Q3 of 200,000, the stock would be trading at over 200 times enterprise value to EBITDA. But again, we could see some future growth here in adjusted EBITDA, but I am annualizing it. And on a Q3 2024 revenue run rate, they've got about 34 million, and this doesn't include the November acquisition. The stock is trading at about 4.7 times forward revenue. So again, maybe a little bit on the pricier side, in my opinion, especially for, we're at this earlier inflection point in the business of them trying to continue to break into profitability. But, I would definitely say revenue and profitability are trending in the right direction, which is good to see. But again, it's still quite early. And one of the things that I would like to caution on is that a growth via acquisition strategy funded by using a company's shares as currency can be a tight line to walk, as you need to grow earnings faster than the share count in order to get meaningful EPS growth, which, of course, at the end of the day is what will drive a share price sustainably higher. If we look at December 31st of 2023, the company had about 111 million shares outstanding. Today, they've got about 127 million shares outstanding. So that share count is increasing. So that's just kind of what I'm meaning. You got to walk that tight line of actually growing earnings and EPS at the end of the day to get that share price sustainably higher. So all in all, given the acquisitions and positive trend in financial results, Happy Belly Food Group is our star of the week.
Yeah, again, this is just my opinion, but this company is significantly overvalued right now. There's growth in the business for sure. Good on them for growing the business via acquisitions, and I'm not sure about the organic growth rate, but good on them for doing that. But it's not profitable. It's $100+ million market cap, and the revenues on a quarterly basis are still quite small.
Mm-hmm.
And there is a net debt position, I think you said, Brennan. So
That is
I mean,
correct.
those things would worry me. The
We wouldn't be
amount of
buying.
EBITDA, there's no net income. Even you can't even squeak out it's almost a tenth of a share or something like that. It's the valuations are high. There are a lot worse companies out there than this company. I'm not saying this is the worst company. It's not even close. They're growing the business. There's probably some good brands in there, but on a valuation basis right now, it is pricey. If my advice to them would be, if you're going to grow via acquisition, raise money right now. Go out
Yeah.
and raise money if you can, because on a valuation basis, it's priced high, and that is the way to be a creative. Go out and raise it in the capital markets, and then buy it at a lower multiple in the private market.
Well, exactly. I
You
mean,
could
you're
possibly
trading
do
it,
that, but
Happy
do it
Belly's
now.
trading at 200 times, annualized EBITDA. Then you're like going out there and making
Please
an
no.
acquisition for 4 to 6, times.
Yeah,
So
like
yeah,
that's what we should do. That's how it could be
exactly.
successful. And we probably have to roll back the shares at some point though. But
Yeah.
anyways, that's my advice for free. Aaron, you're muted.
It's just agreeing that's how you actually grow the profitability and grow into that
Yeah.
valuation is the one benefit of the expensive valuation is that you can use your stock as currency, right? Whereas you can't do that when you don't have a decent valuation.
Yeah. And raise capital now. Happy Valley. That's my prediction.
Let's call them on the podcast
they
right now.
should.
Call management up.
Too bad we don't do that, but not call, but raise capital, because this is what they should be doing.
Yeah.